In a trend sense, since 2020, you can still say, even though we did break the last higher low, in a broader sense, you can say, well, maybe this is still in an uptrend. What we have found very interesting is the correlation between Bitcoin and various other asset classes, gold being an important one of them, where you can see how low the correlation is.
In today's rapidly shifting macroeconomic environment, investors are facing one of the most confusing signal sets in decades. Inflation data, interest rates, commodity prices, equity valuations, currencies, gold, and Bitcoin all seem to be telling different stories at the same time. And when markets diverge this sharply, it usually means something big is brewing beneath the surface. In this analysis, Cathie Wood dives into what she calls a major disconnect in global markets, one that spans inflation indicators, gold prices, Bitcoin, the US dollar, equity valuations, and long-term growth expectations. Rather than treating each market in isolation, she steps back and asks a more important question. What is the market collectively trying to tell us about the next cycle? Cathie begins by highlighting what she sees as a striking anomaly in the gold market. Over the past 2 years, gold prices have more than doubled, pushing its market capitalization to extreme levels when measured against the U.S. money supply. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
Now I'd like to talk about a big disconnect, given everything I've just said about inflation, between a lot of inflation indicators and the gold market. Gold prices have more than doubled in the last 2 years. And here you can see what an extreme they have reached on this basis. So this is the gold market cap as a percent of USM2, US being the world's reserve currency. And you can see that we have surpassed the gold to M2 ratio in the late 70s, early 80s, when inflation was raging at a double-digit rate and interest rates were into the double digits as well. So that's interesting. There's only one other time that this ratio has been higher, and it was during the Great Depression. During the 30s, when the gold price was fixed in the low $20 range and money supply was collapsing. So those two things are not true this time around. The gold price has been going up and the money supply has been going up. And so we're trying to figure out what this means. One suggestion is that gold has entered, I hate to say irrational exuberance territory, but that's the prevailing phrase. Maybe gold is nearly done with this bull run. And then we have to ask ourselves, because Bitcoin is considered digital gold, has Bitcoin, is it done for a cycle? And as everybody knows, the 4-year cycle worry is out there. Well, here you can see the Bitcoin to gold ratio. In a trend sense, since 2020, you can still say, even though we did break the last higher low, in a broader sense, you can say, oh, maybe this is still in an uptrend. We shall see. But what we have found very interesting is on the next chart. What is the correlation between Bitcoin and various other asset classes, gold being an important one of them, where you can see how low the correlation is. So a correlation of 1 means very highly correlated. A correlation of 0 means not correlated at all. A correlation of minus 1.0 means inversely correlated. When one goes up, the other one goes down. This correlation, since 20, is suggesting no correlation. And in fact, if you look across the top line there, the correlation with most other asset classes, Bitcoin versus any other asset class, very low. No correlation with bonds, almost no correlation with gold and REITs, very low correlation with commodities. The highest correlation is with the S&P 500, and even that is a low correlation. And you can look at the correlation between and among the various categories here. You know, Bitcoin's correlations are very low. And what this means is asset allocators have a fiduciary duty to look at Bitcoin and other crypto assets for portfolio diversification, because the lower the correlation, the higher, when adding one of these low correlated assets to the others, adding means return per unit of risk probably will go up. So we think this is a great illustration of that.
Despite widespread narratives about the US dollar's decline, Cathie takes a contrarian stance. She argues that if ARK's inflation outlook is correct, specifically that inflation continues to trend lower, then the dollar may be in the process of stabilizing after its 2025 decline, with the potential to reverse higher. She draws a historical parallel to the early 1980s, when Reagan-era policies drove a massive increase in the dollar. The reason wasn't sentiment, it was returns on invested capital. When capital earns higher returns in one country than elsewhere, money flows there, strengthening the currency. Cathie believes current U.S. policies represent Reaganomics on steroids, creating conditions that could boost productivity, innovation, and capital returns. If that happens, the dollar rising would be a shock to consensus. But markets often move in the direction that surprises the most people.
The other thing I'd like to say about this period of time, given all of the talk about the dollar being so weak, well, if we're right, the dollar is stabilizing here after a decline in 2025 and will reverse course, much like it did during the early 80s. In the early 80s, with Reaganomics, and we think that this administration's policies are turbocharged Reaganomics. Because of those policies, the dollar went up. Why? Because the return on invested capital in the United States went up relative to the returns elsewhere in the world. So we would not be surprised to see a sizable increase in the dollar here, which is completely away from consensus expectations, and therefore very interesting to us. Now, one thing we do have to think about as we're getting into talking about markets here is valuation. So in the purple, you see the PE ratio, trailing 12-month moving average of the PE ratio for the S&P 500 versus inflation. So we're back to this important inflation call. Now, if you look carefully, I know this is messy, but if you look at the early 2000s, you can see that because of the monetary and fiscal stimulus around long-term capital management in 1998, Y2K in 1999, and the tech and telecom bust in 2000, you can see that after inflation bottomed, it moved from roughly 1.5% up to 4.5–5%. And the PE ratio went down during the early 2000s. There is an inverse correlation between PE ratios. You saw it highlighted during 08, 09, and the PE ratio. So you can see where we are now. I think it was instructive to see how low the valuation went in the purple there after COVID. We dropped to 17, 18 times earnings. Now, that was a big correction during COVID. And there was a very rapid expansion in earnings after COVID. So it was interesting to see where this stabilized around that 17, 18 range. Now, why would that be? Could it be that the market in its wisdom is saying, hey, wait a minute, we think inflation is that the next big move in inflation will continue to be down? Maybe. You can see the PE has gone up as inflation stabilized. And I think that surprised a lot of people. Could it be the market is discounting another drop in inflation? And that would support valuations. Now, I'll quickly add that if we're right on the outlook for earnings and revenue, GDP growth, then we're going to see very rapid growth during the next 2.5 to 3 years. Very rapid growth. And so we believe that we don't have to assume these valuations hold. We think that the revenue growth and earnings acceleration that we're going to see, especially in the innovation space, so consider the source, that's all we do, that they're going to overwhelm the high valuation by historic standards and help us deliver a compound annual rate of return well north of the market during the next 5 years. You can see, I think we still have to see this metals to gold ratio turn around to confirm that we're in an upturn in the cycle. And it is, for me, the most interesting chart because, these two, the long-year Treasury bond yield in green and the metals to gold ratio, have been so highly correlated in the past. They've broken apart in recent years. So maybe they'll meet somewhere in the middle during the next few years. Here's copper. Copper is telling us, okay, maybe we're now resuming the cycle. And a lot of manufacturing facilities, anything going electric, demands more and more copper, including transportation. So this is also a secular shift towards copper, which should benefit the price. Here to end are what we've been monitoring, just keeping us on our toes, the S&P to gold ratio. Still basing, it's at the lower end of a base that's been in place for the last 5 to 10 years. We do not think it's going to end up like it did in the 70s. We think instead that the S&P to oil ratio is leading the way, and that is heading for new peaks. That's very, very bullish. We had, if you look at 1980 through 2000, that's the strongest and longest bull market in history. Sure, we had episodic setbacks, but the most powerful. And if we're right, then that the Trump administration is Reaganomics on steroids. This should break out, and we believe the S&P to gold ratio will follow.
What makes this moment so compelling is not certainty, but contradiction. Gold is acting like inflation is out of control. Bitcoin is acting like a new asset class is still being discovered. The dollar is priced for decline, yet fundamentals suggest resilience. Equity valuations look expensive, yet growth may justify them. Cathie Wood's message is clear. When markets send mixed signals, it's often because a regime change is underway. Innovation, productivity, and technological deflation may matter more in the coming decade than the narratives dominating today's headlines.